so we left off at the tax situation for Scott Single and what it's going to look like as he from 50 to work until he retires at 60. And again, the idea is that we want to start drawing money out of our 401k at 60 to avoid taking Social Security to 70, which is what we're doing here. And the tax situation looks like this. All right. So as you can see, pretty significant taxes while he's working, losing a quarter of his money to taxes. And then it drops significantly once he stops because FICA no longer kicks in. And now here's when Social Security kicks in. So let's take a look at the retirement cash flows and we can see what the tax rates look like. Let me see here. I want to check my clock again to make sure that we're not running these videos too long. All right. So let's go to cash flows and let's see. The cash flows. Yeah, there's Social Security. There's Social Security at 70. All right. So basically, actually, let's do this. I want to go back. Bear with me just a second. I want to actually change it so he's taking Social Security back at full retirement age to show you what it looks like. So let's go back to full retirement age where he's taking Social Security, and we're going to go to cash flows. All right. So not a big difference in his ability to retire. It could have an effect on his taxes. So here's Social Security taking it at 67, which is his full retirement age. And so let's take a look. So his taxes at 60 are $7,340. All right, 67,340. His taxes at 55 are $16,809. His taxes at 65 are 8307, and there's a reason I'm writing this down. I'll share with you in just a second. And his taxes at 70 are 3285. All right, 3285. So now the RMDs are going to start kicking in. So let's just go to 80, and his taxes there are 12 at 80 years old are 12,506. They're starting to kick in pretty good. At 85, they're 19,630. So 67 is when Social Security kicks in. He's got pretty big distributions. Planned distributions are RMDs, mandatory distributions, and they're starting to come out fast and furious. And his taxes really start jumping up here as he gets in his mid to late 80s for sure. So let's take a look at one of the taxes. We're going to look at what the tax brackets or the 1040 looks like here in the year when he's 55, which is 2009. When he's 55. Should be 2024, I believe. Let's see. All right. So here's 2024. Now he's only got 69,556 of income, but Josh, he's making 70,000 a year. And again, we're fast forwarding this to 2024 because 10,000 of that in today's numbers, whatever it is in the future, is being deferred. It's not taxable. In fact, if we want to see it in today's numbers, 60,000 of income, but his salary is 70,000 because 10,000 is being deferred into his 401k. So it doesn't flow back to the 1040 because it's being deferred to the 401k. It will, but not in this year. $60,000 of total income minus a $12,000 standard deduction. Pretty simple math here. $48,000 is taxable income. $6,500 is what he pays the feds. And then again, the state of Massachusetts and in terms of a Medicare as well, the FICA. So if we fast forward this till that's when he's 50, let's go till when he's 60 at 2029. He's got no earned income at all. Only thing he's got is coming from his IRA, his 401k/IRA distributions. At that point, the Trump tax bill is over. So we've got itemized, not itemized, but standard deduction, which has been adjusted for inflation. His personal exemption, his taxable income in that case is 5,142. Again, this is just the feds. All right, so let's go to 2039 when he's 70. And see what that looks like now. 2039, he's 70. 26,600 IRA distributions, 46,877 in Social Security, of which only 17,000 is taxable. That's pretty good. And again, because of that, his taxable income is only, let's see here, $24,000. So this is never going to be taxed that low again. He's only paying $2,000 in taxes. But watch this, my friends, 2049. Watch what happens. So we're starting to get some ordinary dividends, starting to get some taxable interest, starting to get some capital gains because he's been taking so much of our RMDs out of his account that is going into a taxable account, which is taxable as ordinary income, or I should say qualified dividends, long-term capital gains, and even taxable interest. 51,000 IRA distributions. He's paying $60,000 of Social Security. And we times that by 0.85. Yeah, so 85%, roughly, not quite 85%, but 80% of his Social Security benefits is subject to taxation. $106,000 is his income, which means he's got a taxable burden of $11,400 at $106,000. He'll probably approaching. Well, he's definitely at the Medicare premium increases there as well. So now he's paying capital gain. He's paying taxes on these gains. Oops, what happened here? Don't want that. Oh, why is it doing that? All right, so I'm not sure how to get rid of that. All right, so he's paying. That's weird. Do I got to click on this or something? All right. Oops. Hi, Josh. Let us know how we're doing. Doing great, except this thing is not. Why is it not? Oh, there you go. All right, so he's paying taxes on his, not much, but he's paying taxes on his dividends. He is paying taxes on taxable interest, and he is paying taxes on his capital gains because he's above the 12% tax bracket. He's not quite paying 85% of his Social Security being subject to tax. That's a fact, but he is in a higher bracket for Medicare Part D and Medicare Part B as well. Probably not the highest bracket, but certainly he's paying more than a regular premium for most Americans would be. All right, so that's 2049, and we can even go further to 2055 and show the taxes. And again, same thing. He's got bigger IRA distribution, 73,000. 85% of his Social Security is now subject to tax, and his taxes just keep going up and up and up. And so that's what we're looking at for him. I mean, again, at the beginning stages of this, not a huge issue from taxes. I mean, just right here. It's not much you can do here when he's working because he's W-2. I mean, you can't escape FICA, the feds, or the state. You just can't. And so right here is a pretty good strategy to start doing stuff right there to move money from IRA, 401k to his Roth. Absolutely should start doing that for sure. So let's do this. Let's take a break. And then we're going to come back and show you what it looks like for a Roth, okay? Because I think that you'll find that pretty interesting on what the Roth looks like. Actually, I do want to show you one other thing, how we do the Roth. It's going to change things quite a bit for Social Security taxation, for income taxation as well. I do want to show you this right here, what his accounts are worth. All right, so now his account in his 401k, let's go down here when he's 401k. Let's say 80 years old. He's got 861 in 401k, and he's got 197 in taxable. So remember, 861 in 401k is not 861. I mean, basically 25% of that is going to the state and the Fed. So he only owns a quarter of that, if that makes sense. So just keep that in the back of your mind because we're going to switch this around a bit. All right, stay tuned. We'll do the next one next. Don't forget to subscribe down below. Comments, questions, concerns, always helpful, and thumbs up as well, too. All right, thanks, guys.